Hi, this is Greg Ehrs, from host of Einstein's Disease. We're back with Steve Hotovec, founder of co-founder of Bearstone. Steve, welcome back to the show.
Thanks, Greg.
So in the last block, we got to spend a little bit of time understanding what your solution is for homeowners. Being able to get cash for equity up front, be able to improve their credit situation, their financial situation, and be able to stay in their home. And I think we kind of went through that pretty well. What I'd like to really do in this next block here is let's talk about some of the other things that we talked about off screen, about some of the benefits from the capital gain standpoint. Our viewers are sophisticated. People understand short-term and long-term capital gains. This, because it's an equity investment or an equity transaction, there are terms to this that are different than there are for debt, isn't it, Steve? I mean,
Correct.
you're going to find yourself in a position where you might be able to have a better tax benefit. So it'd be great if you could, without a chalkboard, give our viewers a little bit of an education on what that actually means, because I think you mentioned off camera, you're paying back money at 60 cents on the dollar, which to me sounds pretty appealing.
Yeah, so let me just walk you through just a quick example. It's kind of like our favorite exercise that we use for homeowners or would-be candidates for this, is to describe, and I mentioned early in the show, what it is and what it is not. So obviously, because it is not a loan, not a line of credit, it's not a reverse mortgage, there's no interest that's actually computed. It's a percentage, okay, of the home's value at settlement that's kind of driven by the ending value of the home. So put simply, if the homeowner gets an advance payment, let's just use a round number of say $100,000. So if that $100,000 is paid to you, there is no it doesn't record on it does not report to your credit. And let's just walk forward and say you use that money to go pay off your credit card debt. Okay, so let's say you had $50,000 of credit card debt, you paid that loan off, and then now your credit score is up, your DTI is down, and you say, I kind of want to pay this off or refinance it. Maybe you took the other $50,000 and you launched the business, things are going well, and now we want to close that transaction out. So when we close that transaction out 1 year, let's just say it's 1 year and a day, the amount that would be due is normally a percentage of the home's value, or they'll be subject to what's called an APR cap. Now, these APR caps or IRR caps is to the benefit of the homeowner, because the homeowner decides when he or she is going to close this transaction. So let's say that cap were, say, 20%. That's normally what they'll run, 18 to 20. Now, that sounds expensive, but it's usually a cap for shorter term. In a longer 10-year product, it'll go to percentage of sale. So what will happen is you will owe the lower of the percentage of the home's value, or subject to the cap. So in this example, you would owe $120,000 to close the transaction out. You got 100, now you have 120. That $20,000 that you pay back is going to be, and I'm not giving tax or accounting advice, you need to check, this is just from experience, will normally be considered a $20,000 capital loss. Okay, so if it's over a year, that'd be long-term capital loss. If it's under a year, it'll be short-term capital gain. Now, the benefit of this, as you know, is a lot of people have other moving parts. They might have losses or gains in stocks, portfolios, etc., and allows those to be kind of capital efficient, if you will.
Got
Does
it.
that make sense?
Yeah. So what you're saying is the money that a homeowner has to pay back, because it was an equity investment, they've just lost, in your example, $20,000 in an equity investment, correct?
Correct, because that's the
So,
settlement amount. Yes.
right. So when they look at that, and it's a long-term capital loss if it's over a year. Then again, we're not CPAs or IRS or anything like that, but you can find that anywhere. What you're saying is that long-term loss can go against other gains,
Correct.
So that makes you more tax efficient from that standpoint. What about the basis of the home? Can you use that to increase the basis of your home
Yeah,
as
yeah.
well?
These
How does
can.
that work?
So there's two ways that we've seen these settle. One, sometimes when they're settling the estate, it'll change the basis because the transaction of the home equity agreement will reduce the basis, right? Or sorry, it'll be rolled. Think of them as collapsed together, right? So if you owed 120,000, that 20,000. So these can be folded together or they can be dealt with separately, meaning that you can close this transaction out without selling the home. Okay,
Right.
so there are many people that have 800 credit scores that are self-employed. Okay, so you could have a 800 credit score and still not be able to qualify for a loan, but you can get a home equity agreement. Okay, and
That's nuts. That
yeah,
really happens a
yeah,
lot.
it more than you think. And when they, um, one last thing is you cannot deduct interest, okay, on a home loan or a reverse mortgage or a HELOC unless you use those proceeds to actually improve the home. Very few people actually use those for those purposes. They normally use it for other things. That's why in a home equity agreement, when you look at the tax status, because it is a real estate investment, okay, it's not a loan. It's very attractive. It takes a next level of understanding, but there's a wide range of uses and
And
practicalities.
and talk to us a little bit about your team because obviously they're not ex IRS agents or CPAs. I can't imagine, but I mean, how how hard is it? Do you have literature that you share with your prospective clients? I mean, how do you educate people on this? Because it is, even though it's been around 10 years, it sounds like there's
Sure.
a little bit more of a challenge that might be in place to help people. And maybe that's part of the reason that the product hasn't become more widespread.
We always start off with about a 10-minute introductory call because you really want to craft it towards the homeowner, understanding what his or her situation is, understanding what their financial savvy level might be. Okay. So somebody might say, I don't really understand finance very well. I, they got to give a basic understanding. But within the agreement, the agreements are very, very consumer friendly. It's spelled out very clearly what this is, what it is not, what it will cost you in order to settle this. So we normally do take a homeowner through a 10-minute introductory, answer any questions they may have, and then walk them through the process, depending on what he or she is trying to accomplish.
Got it. And so, what is the process, Steve? You have this 10-minute introductory call. You've had it with me. I'm interested in one of these. I
Sure.
need it for my financial situation. What walk me through the next steps? How long it takes? What is it that you're going to ask for, et cetera, et cetera?
Sure.
What will disqualify me?
So we normally walk people through what the underwriting process is. So there's just simple. You need basically driver's license, passport. If you have a loan, which most people do, statement of your most recent statement, proof of insurance. There's not a lot on the income side because this is equity based. So there's about three or four things that we look through. We will pull a credit. Normally, we'll do a soft pull on the credit, make sure that there's normally a credit requirement of at least 500 to 550. There are some restrictions if there's any bankruptcies, but generally speaking, the process from start to finish can take as little as 2 or 3 weeks. Normally takes maybe 5 to 6 weeks if the homeowner is pretty diligent in getting things back through. We'll normally use an appraisal or an AVM, which is an automated valuation, to come up with the value of the property. And based on that, that's how much that homeowner will be eligible for. The homeowner can elect to take anywhere between 10 to 20% of the home's value, provided they have enough equity in the home.
Got it. One thing I caught that you said is there's no income verification. So this for touches on a lot of different people that might want or to access this where they don't have this type of income verification. Maybe they're self-employed, or
Sure.
maybe they're between jobs or retired, and maybe they're going to sell their house in 3 to 5 years, but they need some money. Talk to us a little bit about that when you say no income verification. What does that actually mean?
Well, you hit on pretty much every because home equity agreements are based on what we call your ability to stay. This is not a loan, so there's not really debt that needs to be serviced. You just have to have enough equity. So it's an equity-based solution. So as you expressed, people that are self-employed, maybe they're in between jobs, maybe they're retired. You could have a retired couple that really has a lot in savings, wouldn't qualify for a loan, but they would qualify for a home equity investment. So you really aren't concerned with determining the ability to repay, because you already have that ability to pay this back, because it's backed by the equity that you already have built up in your home.
No, that makes sense. So, um, as we close out this block, it's interesting to understand not only the some of the benefits you talked about from a tax perspective, but we obviously tell all of our viewers seek professional advice on that. But it makes sense from a long-term capital loss for that. And then it really seems like a pretty easy process. Is that much different than it takes to get a mortgage or a HELOC? Anywhere from 5 to 6 weeks. Is that a pretty standard
It,
number?
it,
Are you in the same ballpark?
yeah, it can be even faster, but we try to understate and overperform, if you will. I think because the documentation, there's only 3 or 4 things, and it's all equity based, can be much faster. Probably the gating item is making sure that the homeowner understands, and oftentimes they'll talk to their accountant, attorney, etc., for them to get familiar, or there might be other people that are involved in the decision making process. That's probably the bigger challenge, is making sure the homeowner understands what it is and what it is not. The
Got it.
documentation is not very difficult.
I got you. With that, we're going to cut away to our sponsor, Steve. I'd like to have you come back for the last block and finish this up. It's been a very insightful show so far, and I really appreciate you being here. And with
Great.
that, we'll be back shortly.
You break past limitations and rethink success. Are you ready to push the boundaries of what's possible?